I suspect that a lot of investors will be concentrating on earnings in the next few weeks because these events, as unfortunate as they are in terms of political change, do not really change the direction of global markets and the global economy. So we focus on them for a couple of days. We look at the likelihood of a scenario change. We shift a few percentage points left and right. And then we look at the real economy, what companies are doing, how households are behaving, how central banks are reacting to the long-term inflation, disinflation picture that we see effectively take place.
That big question over inflation is quite key because even as you look at what some of Trump policies are, whether that does fuel inflation down the track with more spending, tax breaks that are rolled over and also changes around any tariff regime. What does the last mile look like as we talk about the next couple of months for the Fed? Is inflation coming back to target quickly?
I think that for most of them, they look back at where they were, where they think they're headed, and are they close enough to the point where they need to flip? Because it's very rare, historically, to find the leading global central banks deviate from what their peers are generally doing. And what we think is happening in terms of underlying inflationary pressures in the US is pretty obvious. It is that goods price inflation is normalized, and it's just this lagging indicator of US services and inflation within housing, which is pushing us perhaps slightly later than the others to envisage that move, but it's coming. I think that by the end of this year, we'll probably look back and say the Fed was right to be cautious, but they still cut rate 2 or 3 times.
That's pretty robust on your part, saying 2 or 3 times as well. How bad is the US economy that needs 3 rate cuts?
I think it's dependent on the labour market, which has been softening quite significantly.
No, it hasn't. Sorry to go up against the might of Citi, and I say this with trepidation because you're the investment banker and I'm a mere hack, but it hasn't been dramatically full. The numbers historically are still incredibly close to full employment.
It is, but
and
at the
same time,
if you
look at the ongoing claims or the weekly claims as well, or any of the data, and the quits versus hires on the jobs, it's not a dramatic change.
I've never said it was dramatic, but I think it's...
You said it's significant.
It is a significant because
What's
it's a flow.
What's the difference between significant and dramatic? I'm being a pedant here.
It's a flow issue, it's not a stock issue. And for central banks, it's about a delta. Is a delta pointing towards higher employment? Unemployment, yes, it is.
Yes.
I mean, we've seen the jobless rate go up by 5 to 6 decimal points. We see it broad in terms of the states in the US where it's happening, and we see a significant moderation in wages. And therefore, if you're the central bank, which has a dual mandate, one of the few in the world, and inflation is heading towards target, and core PCE will be probably at 2% by the end of this year, why can't you take interest rates down a little bit to avoid over-tightening?